On a finished data center site outside Phoenix, a transformer sits on a concrete pad, still wrapped in plastic, exactly where the crane left it. It was ordered 3 years ago. It finally arrived. And it is going to sit there, untouched, for months. Not because of a chip shortage, not a power shortage, not even an equipment shortage anymore, because there is no one to install it. This whole series has followed one wall behind another. The chip, the power, the transformer. Today we reach the last one, and it isn't a machine at all. It's a person. By now, the demand isn't in question, and neither is the money. The chips are being made, the power is being contracted, and the equipment we covered last time is finally starting to ship. So the finish line should be in sight. Every input is arriving, except the one that actually turns a pile of steel into a working data center, the skilled hands that install it. Electrical work alone is somewhere between 45% and 70% of what it takes to build one of these buildings. And the people who do that work are running out. Here's the wall. It's an electrician. According to the U.S. Bureau of Labor Statistics, the trade needs about 81,000 new electricians every single year, just to keep up with growth and retirements. And close to 30% of today's union electricians are near retiring. At the same time, every AI data center, every new factory, every EV charger and grid upgrade is fighting over the same shrinking pool of licensed hands. The president of Microsoft has publicly called the electrician shortage the #1 problem slowing America's data center expansion. Oracle pushed one major project's finish date back a full year, with labor shortages named as a cause. So think about what that does to the companies that actually employ these people. When the scarce resource is skilled labor, the winner is whoever already has it under contract. Quanta Services, ticker PWR, does something most contractors don't. It self-performs 80 to 85% of its own work. Instead of leaning on subcontractors for the scarce labor, it keeps most of those crews in-house, which, in a shortage, is the entire advantage. Last quarter, it posted a record backlog of $53 billion and raised its guidance for the year toward $40 billion in revenue. And EMCOR, EME, the largest electrical and mechanical contractor in the country, just booked a record $17 billion in remaining work, up 44% in a single year, and raised its own guidance on the strength of data center demand. Notice what they're being paid for, not a product, a workforce. Now, a record backlog usually just means a company is busy. Here, it means something more. About 3/4 of EMCOR's backlog is expected to become revenue within a year. And management is clear that the constraint isn't finding the work, it's staffing it. EMCOR's own growth playbook is buying up union electrical contractors, locking in crews of licensed workers, and then layering data center projects on top. That's the whole game in a labor shortage. An order book is only worth something if you have the people to deliver it. These two companies do, most don't. A smaller pure-play MYR group, MYRG, tells the same story in miniature. Record revenue, record backlog, riding the same wave. The backlog is the promise. The workforce is what makes the promise real. So step back and look at the whole chain we've built. To turn $1 of AI spending into a running server, it has to pass through a chip, a power plant, a grid connection, a transformer, and finally, the crew that installs it. 6 gates. This is the 6th. And it's the same lesson every time. You don't get paid most reliably by owning the thing everyone's racing toward. You get paid by owning the narrow step they all have to pass through and can't skip. And here's the thread that ties it all together. On its last earnings call, Quanta detailed a plan to spend up to $700 million doubling its own transformer manufacturing. And management called that build-out, in their words, a labor force multiplier. The same company standing on today's labor wall is building its way onto last episode's equipment wall, too. That's what a real choke point looks like. The last mile isn't a transformer, it's a person. And very few contractors are built to field that workforce at this scale. Now, before you write those names down, turn it over. Every argument so far assumes the shortage lasts and these companies keep winning. Here's the other side. First, the same labor shortage that is their tailwind is also their single biggest risk. If they can't hire and keep enough skilled workers, they can't convert those record backlogs into revenue. And the analysts watching these stocks flag labor pressure as a top downside for both. Second, these are not cheap. Both PWR and EME have already run enormous distances and trade near record highs. They're priced for this boom to continue without a stumble, and a single missed quarter can undo a lot of that, fast. And third, the shortage may ease. Electrician apprenticeship applications jumped about 70% in just 2 years, and firms like BlackRock are pouring money into training new tradespeople. The catch: training a licensed electrician takes years, not months. So this is a real, expensive, multi-year squeeze, but it is not permanent. Anyone who tells you it lasts forever is selling you the top. So here's the board. 2 names, the ones who own the scarce workforce. PWR, Quanta Services, self-performs its own crews, record backlog. EME, EMCOR, the country's largest electrical and mechanical contractor, buying up union labor. And one name is context, not a pick. MYRG, MYR Group, the smaller pure play running the same race. This was never about who builds the data center. It was about who has the people to turn it on. Now here's the part that actually matters for you. Because the point was never to hand you 2 tickers. It was to hand you a method. And here's the thing. You already watched it work. Everything we just did, finding the shortage, checking who controls it, testing the numbers, that was the method. So here it is, pulled straight out of the story to run yourself on the next boom. AI, energy, anything. 1. Find the real bottleneck. Not the thing everyone's talking about, the narrow step hiding behind it. 2. Make sure the company actually controls that scarce resource. Quanta self-performs most of its own work. A firm that only subcontracts the scarce labor doesn't pass this test. 3. Check that the backlog is turning into real revenue and profit, not just a big number in a press release. 4. Ask whether they can hire and keep enough people to deliver it. In a labor story, that is the whole game. 5. Compare the price to the growth already expected. Near record highs. A lot of good news is already baked in. And 6. Ask what would prove you wrong. For these 2, it's simple. Labor they can't staff, or a valuation that finally cracks. Run those 6 questions and you're not following a stock tip. You're doing the work yourself. That's the difference between a viewer and an investor. So there's the whole chain. Print the chip, package it, generate the power, connect it, deliver the equipment, and install it. 6 walls. Every one of them a place where the whole trillion-dollar machine can stall. And at the very end, the thing standing between all that capital and a single dollar of profit is a person, with a license and a pair of hands. Which leaves one question we have never actually asked in this series. After all 6 walls are cleared, does any of it pay off? Is the money at the end big enough to justify the mountain of money at the start? Next time, we follow the money out.